Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel and a topic we need to talk about. Now Nation, we've talked about the retirement crisis before on the channel. It's just insane that 4 in 10 retirees are living on nothing but Social Security. That's about $1,300 a month, and considering average spending by those 65 and older comes to just over $4,200 a month according to the BLS, it's not nearly enough to live on. And I've seen it firsthand. When my mom retired, her entire income relied on that $860 a month from disability. It was subsidized housing and scraping to get by each and every month. That is not how you want your golden years to be. You have worked too hard. You've worked too long to be scraping by in retirement. So for this video, I wanted to help you create a monthly dividend stocks portfolio to create a little gold in your golden years. Show you how to put together a portfolio that will put cash in your pocket every single month. And I want to start here with how to pick monthly dividend stocks for your retirement portfolio. Now, I'll show you 5 of my favorite later on, but I want you to know how to find the best for your money so you can create that portfolio yourself. I'll then get you started with 2 great monthly dividend funds and then reveal those 5 dividend stocks paying an average 7.5% dividend yield and putting that money in your pocket. Before we get started though, you know I've got to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So now, when it comes to picking those monthly dividend stocks for your portfolio, you really do need to start with what you need out of those stocks. Because the stocks you pick for maybe those longer term growth and dividends are going to be vastly different than those you might pick for a retirement portfolio. For example, in that growth or long-term portfolio, you might be okay with maybe a little bit more risk. Maybe some of these monthly dividend payers that are a little more volatile, the total returns and even that dividend are at risk, but the upside is going to be higher. For the retirement portfolio though, safety is going to be your most important goal. You need those dividend payers with an ironclad record of making those payments and the stock prices that aren't going to destroy your returns. Because Nation, if there is one thing that high dividend yield stocks are notorious for, it's luring investors into that promise of the easy money, only to leave them with nothing but losses and disappointment. Take shares of Armor Residential, ticker ARR. It's a real estate trust with an undeniable 12.5% dividend yield. That's an amazing yield until you consider that the stock price has been cut in half over the last 5 years. Even including that dividend, investors have lost 4.6% a year. Prospect Capital, another darling of dividend investors, who can resist a 14% dividend yield here? But with the shares down 32% over the last 5 years, investors have really only booked a 4.3% annual return. So the first thing I want you to do looking at these monthly dividend stocks is to not chase those high dividend yields. You need to be looking at that price chart, making sure that those losses aren't wiping out all your returns, and make sure that the company has that long-term upside to higher cash flows. Second here is to make sure you're diversifying your types of dividend stocks you buy. Nation, the problem here is that most monthly dividend stocks tend to be from just 4 investment types. That's mortgage REITs, MLPs, which are master limited partnerships, BDCs or business development corporations, and equity REITs. Now, these can be some high-yield investments, but they can also be extremely risky and can drop investors into those plunging stock nightmares. So I'm going to show you 2 monthly dividend funds next that are going to help you spread out your risk over stocks. But remember, when you're looking for these monthly payers, make sure you're investing at least across a few of these business types. Okay, now the fun part, and we'll start with those 2 monthly dividend funds. Now, I like these as a part of your portfolio for 2 reasons. One is that they're going to give you that exposure to regular dividend stocks, something you aren't going to get with these monthly payers that are either REITs, MLPs, or those BDCs. That means you're going to spread your risk out a little bit more across the hundreds of stocks in these funds and collect those monthly dividends without losing sleep over your money. Second, though, is that these funds leave some room for growth besides the dividend. Since the stocks these funds are investing in are growing their share price as well as that dividend, you get the potential to grow your portfolio as well as just stash those dividends in your pocket every month. Now that might seem obvious, but it's not always the case with these individual monthly dividend stocks. They may be able to sustain that 10 or 12% yield, but that's all about the return you can expect. So it's just nice here to have a part of your portfolio that's growing the capital as well. And our first monthly dividend fund here is the Invesco S&P 500 High Dividend Low Volatility ETF. That's ticker SPHD. It's a favorite among investors and pays a 5.4% yield. Now this is a great dividend stock ETF because it combines the search for those higher yields with a lower risk profile and those lower volatility. The fund invests in 50 stocks of U.S. companies with the highest dividend yields that have also historically been safer than others. It's a little bit more concentrated in a few sectors here, including real estate, utilities, financials, and staples, but those just tend to be those that are less volatile than the economically sensitive stocks. And dividends have held up surprisingly well on this fund this year. This is probably due to the fact that these companies are just less sensitive to the economy. While the yield of 5.4% is lower than some of the monthly stocks that we'll look at, the fund has produced an 8.5% annual return since inception. Now, the next fund I'm adding is the iShares Preferred and Income Securities ETF, ticker PFF, which holds preferred shares of 489 companies and pays a 5.7% dividend yield. I really like preferred shares during this stage of the economy, and it's actually one of Warren Buffett's favorite strategies as well. And preferred shares are a higher class of stock issued by companies with a guaranteed dividend that's going to get paid out before ordinary stockholders. Now, these shares are first in line after creditors in any kind of a liquidation and can be converted into regular shares of stock if the stock moves higher. So these preferred shares are just a safer asset class in or leading into a recession because they have that higher right to assets. And while the dividend can be paused, preferred shareholders are always going to get all their back dividends owed before regular stockholders even get a dime. And these are the investments Warren Buffett used when he bailed out the banks in 2009, buying billions in preferred shares in those banking stocks. Now, almost half the fund is in banks and those diversified financial companies, but a lot of that is just a function of the fact that these financial companies just happen to use those preferred shares more than other sectors. You're also going to get great exposure to some of these other sectors like utilities, real estate, and 6 other industries. This is another one with a little bit lower yield, but a great upside on that total return. The fund pays a 5.7% dividend yield, but has produced a total return of 12.5% annually over the last decade. That's our 2 dividend funds, and again, I love these for that exposure to stocks as a complement to those monthly dividend stocks that we'll look at next that are going to be more concentrated in those other business types like REITs and business development corporations. And before we get to those individual stocks, though, I want to throw this out to the community. Which do you prefer, or which is more important to you, the dividends or the stock appreciation? Now, like I mentioned, the monthly stocks pay some amazing dividend yields, but don't leave a whole lot of room for those price returns. And while the funds, on the other hand, it's a little bit of both. So which do you prefer, or does it really matter to you? Scroll down and let us know in the comments below, dividends versus stock price. Our monthly dividend stock pick is one of my favorites here, Stag International, ticker STAG, and its 4.4% dividend yield. Now, that 4% yield won't be the highest in the list, but this stock has produced a 16% annual return over the last 5 years and is one of my favorite property types right now. Stag owns 450 industrial and warehouse properties across 38 states for a total of 91 million square feet. And now, while a lot of those other property types like office and retail have really struggled this year, the warehouse market is red hot. The rise in e-commerce and that online shopping has just destroyed the retail property market, but all those online orders need to be stored somewhere, and that's meant a boom in warehouse demand. In fact, 43% of Stag's property portfolio is involved in that e-commerce activity. No tenant accounts for more than 2% of the company's total rent revenue, so the odds of a tenant failure vacating lots of space is pretty much zero. Shares trade for just 13 times from funds from operations, so a solid value play here, and the company only has $300 million in debt maturities over the next year. Next here is Dynex Capital, ticker DX, and a solid 9.7% dividend yield with an upside potential. Dynex is a mortgage REIT, an MREIT, which means instead of holding the properties itself, it invests in the mortgages and then makes its money on the difference between those long-term rates and the short-term borrowing. And most of the loan portfolio is in agency, residential, and commercial loans, which are those loans backed by one of those 3 government agencies. That's Fannie, Freddie, or Ginnie Mae. So these are very strong loans for the most part. And nation, whether you're investing in Dynex or not, the most important thing you can watch for on these mortgage REITs is what's called the net interest spread. Now, this is the difference between what the company is collecting on those loans and what it's paying on that short-term funding. And the good news here is that we saw the spread increase into the second quarter from about 1.5% to 2% mid-year, so better profitability for this company. Now, MREITs do tend to be more volatile than those traditional types of REITs, those equity REITs that own the property, but they also pay out those higher yields too. Shares trade for just under book value of about 0.94 times book, which is right around that long-term average for the stock. Now, like some of these other monthly payers, there probably won't be a huge amount of price upside here, but you can count on that 10% dividend yield every month. Our loan BDC here is Horizon Technology Finance Corporation, ticker HRZN, for a 9% dividend yield. So BDCs, or business development corporations, these companies make loans to small and mid-sized companies that are really too big for your regional banks, but still too small to get money from the capital markets. Now, Horizon makes secured loans to venture and private equity-backed companies in the life sciences and technology industries. And honestly here, is there any other better place to be investing in right now? The portfolio of loans is well diversified by sector, geography, and company stage. Now, all of these are going to be that fast-growing startup idea backed by venture capital, and again, a great niche in that healthcare and the technology space. The average yield on the portfolio debt is 16.3%, and this is something you want to watch whenever you're investing in this or any other BDC. Now, that average debt yield is going to be the interest the firm is collecting on its loans. So it's important that that rate is above what the dividend yield that's going to be paid out to investors, just as a sign of dividend sustainability. Horizon has all the funding it needs near term, with a $45 million share offering earlier this year and a $100 million debt facility. Now, shares are paying that 9% dividend yield and paid a special dividend of 0.5% last April as well. So I wanted to get an MLP, a Master Limited Partnership, on the list. And here we have Sabine Royalty Trust, ticker SBR, an energy trust established in 1982 on landowners' royalties and other energy assets. The company has an oil and gas portfolio that covers over 2 million acres in Florida, Louisiana, Mississippi, New Mexico, Oklahoma, and Texas. Reserves on the assets are estimated to be able to produce for at least another 8 to 10 years, and the parent company regularly explores for new assets. Now, energy has been one of the hardest hits this year, and Sabine is no exception, but it's still paying out that very solid 8.3% yield and has some great assets that are going to support those shares. The stock is trading 52% off its one-year high, so even if it takes years to get back there, you're going to be booking a solid double-digit return, including that dividend. Our next monthly dividend stock here, LTC Properties, ticker LTC, and its 6.5% dividend yield. This real estate investment trust owns 180 properties in 27 states, with skilled nursing accounting for 56% of revenue, and then assisted living bringing in around the rest. Now, shares are down 33% this year for obvious reasons related to the pandemic, but I was really surprised researching this one that occupancy is relatively flat from last year. That's about 85% in assisted living and about 80% in skilled nursing. Now, the company has been able to collect 92% of its rent due from property managers through the second quarter, so it doesn't really look like the virus has affected the operations to the extent that was feared. Even if vacancies do tick up a little bit or the economic recovery stumbles, LTC has over $503 million in an available credit line and $50 million in balance sheet cash. The company has long-term debt of $689 million, but only $185 of that is maturing through the next 2 years, so it's got all the liquidity it needs to make it through this. Long-term, this is just a great play on America's aging population and the demand for senior living facilities, and the stock is selling at a discount. Shares pay a 6.5% yield and have produced a total return of 12% annually over the last decade. Click on the video to the right for our 2021 portfolio, how I'm positioning for the next year, and my best picks to beat the market. Don't forget to join the community by tapping that subscribe button and clicking the bell notification.